Well, good morning, good afternoon, and good evening to wherever you may be tuning in from around the globe. My name is Steve Hoffman, Director of Business Development for GTN, and welcome to the Mobility Tax 101 webinar, the first of a three-part series on mobility tax. These webinars are being presented by Air Inc. and GTN. GTN serves the mobility tax compliance and consulting needs of organizations with emerging to mid-sized mobility programs, while Air Inc. provides the right data, cutting-edge technology, and thought-leading advice needed to effectively deploy talent worldwide. Our speakers today are Chris Hall, Managing Director for GTN's Atlantic region, and Pat Juergens, Director of Global Tax Research and Consulting at Air Inc. Chris joined GTN in 2009 and serves as Managing Director of the Atlantic region and its comprehensive expatriate tax services. He has more than 20 years of expatriate tax experience, working with Deloitte in New York since 2002. Prior to that, Chris worked with Deloitte in Canada and Arthur Andersen in the US and UK. Chris graduated with honors from the University of Leeds in 1997 with a Bachelor of Arts degree in economics. He is UK tax qualified and is an overseas member of the Chartered Institute of Taxation. Pat joined Air Inc. in 2006 and directs Air Inc.'s income tax products. Pat has 31 years of experience in expatriate taxation and global mobility consulting. Prior to joining Air Inc., Pat spent more than 18 years with PwC's International Assignment Services practice, providing tax compliance and consulting services to multinational companies and their assignees. He received a BS in Business Administration and Accounting from the University of Colorado, is a CPA, and a member of the AICPA and MSCPA societies. Our agenda will cover the basics of international mobility taxation, income, expenses, and allowances of mobility, what is taxable and what's not, introduction to gross-ups, and finally, managing international assignment tax costs. Before I pass this over to our first presenter, I want to cover a few housekeeping items. There will be one continuing education credit per CPE offered for CPAs. In order to receive this credit, please select yes when asked if you would like to receive CPE credits in the fourth polling question towards the end of the webinar. One continuing education credit for CRP will also be offered for certified relocation professionals in both the live version and the recorded version. The seminar ID will be provided at the end of this presentation. Please use the question panel to ask any questions. We will allow time at the end of the presentation to answer them. If we don't get to your question, we will follow up after the webinar. You have joined the webinar in listen-only mode, and the webinar is being recorded. If you are experiencing any technical difficulties, please use the raise hand feature and we will assist you. You will receive a copy of today's webinar recording and a PDF of the deck via email. There will be a short survey at the end of the webinar. Please take time to complete this, as your feedback will help us improve these webinars going forward. With that being said, I will pass this over to our first presenter, Chris Hall.
Hello, everybody, and thank you for the introduction, Steve. It's a delight to be here presenting today with Pat and our friends from Air Inc. We really sort of brought this together as a presentation to help answer a need that we have seen in the marketplace. We've continually been asked for basic tax introductions, and what we're putting together here is a kind of a three-part series that will build up. Today we're really focusing on the basics, and then as we move through to our second and third webinars, we'll be adding some more complications and some more flavor to that. At the beginning here, what I'm going to talk about is mobility taxation, and I think this is one of the things that I would strongly recommend that people take away from this presentation today, is that if an employee is working in a location other than their home location, there will be implications. There's a lot of myths out there and a lot of untruths as how and when things start. And I believe there's also a lot of projection of people of things that can be impactful on mobility tax. But it really is that the clock can start the moment somebody crosses a border. And that can be an international border, and for those of us here in the US and in Canada, that can also mean as when you cross a state or provincial border. There are considerations that need to be that come in for income tax, social security, and payroll. For example, in the US, we really have no rules as to when taxation will kick in, and therefore there are no set de minimis levels. In Europe, we're seeing posted worker directives that are prompting some companies to get certificates of coverage for Social Security for their entire traveling population. And I think it's also true to say that a lot of this taxation is really driven, or a lot of the requirements are now driven by guidelines that aren't necessarily 100% clear. And so there is a process of making sure that you are protecting your company to the best of your ability. So if we can move on, and you know, one of the first questions I see is, well, when does a jurisdiction have the right to tax? When does it start? And I think the simple way to remember this is that it's when they choose. There are no golden rules within the tax system, within the international tax system, that says a country can't tax somebody until they've been there for 20 days, 60 days, 100 days. That doesn't exist. For example, some countries will set a de minimis amount of time, such as Hong Kong. They set a 60-day threshold. That is their own domestic legislation. That's not something that has been put on them by some kind of international ruling. That is just what they choose to do. A lot of other countries, I would say the majority of other countries, are not providing that kind of detailed days of presence guidance. And therefore, when you're looking at this, you have to understand that these requirements can start, requirements relating to income tax, social security, and payroll can start at very, very low levels. In some countries, as little as one single day of presence. So again, we're here today to really help guide you as mobility professionals and to look out for those areas of risk. So again, just the one thing I would leave you with is don't make assumptions, because these requirements can start at very low levels. One of the things I also hear about is when a country has the right to tax an ability, has the taxing ability to tax income. What does that actually mean, and how do we allocate income to that? So on the next slide, what we're going to talk about here is a phrase that you'll often hear in mobility tax, the concept of sourcing. And one of the things, again, the main point I would remember at a basic level is that generally where an assignee is paid is entirely irrelevant to their taxation. And as I've added on the slide there, otherwise, if you think about it, otherwise we'd all get paid out of a non-tax jurisdiction. So generally where somebody is paid is not going to be relevant to whether or not they are taxable. We have to, as tax professionals, we have to look at what is known as the source of the income. So the source of the income is really based around the work location of the individual employee. Now, there are a multitude of discussions and advice out there around how particular types of income are sourced, and we will come back to some of that later in the series. But really, it's, you know, if you're spending a certain amount of time in the country, that portion will be considered to be sourced in that country. So in the example here, we have my colleague Pat, who's on the presentation with me. He's making $100,000 a year. I should point out right now that these numbers are all made up. I have no idea how much Pat makes, but on the assumption that he spends 20% of his working time of the year in Canada, then 20%, or 20,000 in this case, of Pat's income is considered Canadian sourced income. So moving on, we get to the fact that once an income is sourced within a jurisdiction, that jurisdiction is typically has the principal right to taxation. And what does that mean? It means that if you're working in that country typically has the principal right to tax that income. Now, there are tax treaties in place, and a country will sometimes forfeit its right to that taxation through a tax treaty. However, and again, we are actually talking a bit more about tax treaties in the second webinar, but a couple of things to note about tax treaties is they are not all encompassing, and they are by no means comprehensive in terms of the amount of tax treaties we have in the world. There are some major countries that do not have tax treaty agreements between them. A classic example of that is the US and Singapore have no working income tax treaty between them. Again, two very, very popular expatriate destinations, but there is no agreement between the two countries. And therefore, both countries, under certain circumstances, have the right to taxation. So when we have that taxation, and so, sorry, before I move on, just to go back to treaties, even when there is an agreement between two countries that they have a treaty in place, it should not be assumed that that treaty will automatically cover and protect an individual from being taxed in the other country. There are a large amount of nuances. There are a large amount of times when those nuances will negate the impact of the treaty. And there are a large amount of times when a corporation, for other risk purposes, should and would choose not to use the treaty and would use or would choose not to employ that treaty through means of protection in corporate tax areas, maybe immigration areas, things like that. So we have a scenario here where we have established that two countries may have a right to tax the same income. Someone, going back to my example of Pat, he's a resident of the US, they have a right to tax his income. He's spent 20% of his time working in Canada. They have a right to tax income. Typically what we'll see in international taxation is that double taxation is rare, but it's not impossible. So there are times when double taxation can arise, but it is not common, even where two countries don't have a tax treaty in place. There are usually, and again, I'm talking in general terms here, there are usually mechanisms in place that would allow for the avoidance of double taxation. So, for example, going back to the example that we have of Pat being in Canada, what would happen in that scenario is that Canada would have the right to tax $20,000 of his income and would do so on a non-resident tax return. And at the moment, I'm just talking about the individual, not payroll. I shall come to that later. Then on the second side, the US has the right to tax the entire $100,000 of income on his resident tax return. On that US tax return, we would foreign source the income, the $20,000, and claim a credit for the taxes paid to Canada on the same income. Now, again, a very, very simple, simplistic example. There's a lot of complication that goes into how you source, when you source, what taxes are creditable, etc. But that is the basic principle, is that there are usually mechanisms that allow for the avoidance of double taxation. As we move on to the second part of taxation, which we often see, Social Security tax. Again, if I'm giving basic lessons and basic messages today, the most important thing to remember is that Social Security tax is not income tax. They have different rules, there are different methods of sourcing, there are different qualifications, different tax rates, and very often different taxing jurisdictions within the country will administer Social Security. And therefore, one of the key features to remember when dealing with cross-border situations is that it's not just okay to work on just an income tax approach. It needs to have an included but separate consideration of Social Security. So, for example, in the US, only has a very limited number of international agreements that cover Social Security, whereas we have hundreds of tax treaties. So there are circumstances, for example, India is, again, another very popular expatriate destination and expatriate sender to the US. There is a tax treaty in place, but there is no Social Security agreement in place. So again, there may be a situation where you have an individual who is not taxable, but is subject to Social Security. So again, just the main thing to remember on that is that Social Security is different and must be considered differently because it represents a different reporting and risk profile to your organization. And that really, Social Security is really typically a payroll tax, and that leads me into my final section here before I hand off to Pat to talk about gross ups. Is that a question I get a lot is, well, can't the individual just report this on their tax return or report it on a tax return? In general, that ability, well, I would say it's always been questionable, but that ability is getting less and less and will become less and less as we progress through the years and as technology drives us to different places. Compliance is fundamentally being driven by payroll reporting and withholding requirements in the majority of jurisdictions that we see. That is where mobility tax can present the biggest area of corporate risk exposure to an organization. Just say that again. That's the biggest area that mobility can create for an organization in terms of corporate risk, is through a failure to report payroll properly. There is now, on a global basis, certainly the UK and Canada, India, Australia, we're seen as leading the way on this, but many tax jurisdictions, the expectation is of corporate responsibility and of your ability to manage the necessary processes to ensure that you are, as an organization, 100% payroll compliant. So again, those days of just being able, we'll have the individual doing it, or we'll just give Dave $250 to do this, that's not going to work anymore, I'm afraid, because that doesn't mitigate your corporate risk. And with that, I think we're going to have a polling question, then I'll pass on to my colleague, Pat.
Okay, the first polling question. Which of the following statements is true? A, no income tax until 30 days has passed in the country. B, Social Security and income tax have the same rules. C, payroll is a large area of corporate risk exposure. Or D, if a tax treaty is in place, there is no host tax. And we'll give a few minutes for folks to answer that poll. Get your end results now.
Okay, the results are showing on the screen right now, and it looks like 94% of people said payroll is a large area of corporate risk exposure. That's the true statement.
Folks are paying attention. That is exactly the right answer. Hello, everyone. My name is Pat Jurgens, and I'll be picking up on the next section. This section will be talking about what's taxable and what's not taxable. What types of compensation would you expect in a typical mobility arrangement? And I would say that the general rule here is that if there's items being paid by the employer, either to the assignee or on behalf of the assignee, it's probably taxable. And keeping in mind that concept that Chris was talking about in terms of sourcing, think of it in the term of, well, why would an employer be making these types of payments if not for the employment relationship? And because of that employment relationship, then that will generally be considered employment income. There are some exceptions to that general rule, and that will allow for certain items to be excludable, non-taxable. Those will be provided by local tax statute and regulations, and these obviously will vary by jurisdiction. So you could have a particular item that would be non-taxable in the host country, but taxable at home, or vice versa. Non-taxable in the home and taxable in the host. So you really have to look at the tax code in each of the jurisdictions. Sometimes the taxability will differ depending on the length of the assignment. And this is in the concept typically of assignments less than a year or more than a year. That's certainly the rules with the outbound from the United States. So there would be the concept on a short-term assignment, less than a year. You really are on an extended business trip, and so certain items would be considered business travel expenses and non-taxable. But once you've crossed over that 1 year threshold, the presumption is that you've actually transferred your job location. So any items that would be paid on a long-term assignment are more likely to be considered taxable. Sometimes, depending on where the individual is going, you might be able to take advantage of certain expatriate tax concessions in that particular host country. And similarly, local tax law may provide for partial taxability depending on what the criteria is. And again, I think I mentioned in the context of short-term that certain expenses may be considered non-taxable if you can categorize it as a true company business expense. Last but not least, there are certain allowances that are not taxable to the employee only because that particular tax system will require the employer to pay the tax. Typically, this is in the context of fringe benefits or benefits paid in kind. And if that particular jurisdiction, the most notable one is the Australia fringe benefit tax, then the company is paying the tax on those fringe benefits. It's not chargeable to the employee. So considering your typical expatriate compensation package, a number of different things that you would typically see potentially provided. Some of these items are excludable, but a lot of times the pay delivery method will also drive whether it is taxable. So benefit in kind, maybe that's considered to be a fringe benefit taxable item. Maybe the company is reimbursing for direct expenses, the actual costs of that particular item. And the third is a simple cash allowance to the assignee. Generally, we see that if it's a cash allowance that's provided to the assignee without any sort of accounting for it, that will be considered to be a taxable compensation element. Here's some examples of some items that maybe are non-taxable. In Japan, you are able to take home leave, qualifying home leave as a non-taxable item. In the Netherlands, you may actually be able to qualify to have a portion of your compensation to be tax-free. It's called the 30% ruling. So essentially it's what it sounds like. 30% of your compensation is tax-free. In the United States, if you are on a short-term assignment and you're provided with per diem or a short-term allowance, those items can be excludable up to the daily thresholds that's set by regulation. And in Hong Kong, employer-provided housing may be partially taxable, and that's determined as a percentage of total income. Maximum percentage is 10%. Now, if we paid a cash allowance for housing in Hong Kong, don't get to take advantage of that rule, the entire cash allowance would be taxable. And finally, as an example here on this slide, in the United Kingdom, certain moving expenses and relocation costs can be non-taxable, but only up to a threshold of £8,000. So if the move costs more than £8,000, the excess is taxable. Okay, polling question number 2. How does your company determine taxable allowances? A, tax provider guidance. B, payroll provider guidance. C, internally by the global mobility team. D, depends on local expertise. Or E, I don't know. All right, we'll just give that a few minutes, or about a minute.
Okay, Pat, I'm sharing the results on the screen right now. It looks like 70% said tax provider guidance, followed by 21% internally by the global mobility team. Then we have a tie in third place at 15% for payroll provider guidance and depends on local expertise, followed by 9% that do not know.
Oh, good. This is exactly what I expected the polling results to be. I think most companies are looking to their tax provider for specific guidance as to what would be considered taxable or not. Excellent. All right, we're going to move on now to gross ups. One of the items I didn't mention as to what's taxable or non-taxable, the biggie here, if the company is paying the assignee's tax liability itself, guess what? That tax reimbursement is also considered to be taxable. So since it's now taxable, you have this pyramiding issue, the tax on tax problem. And so they no longer have the proper net income to cover the taxes associated with that tax reimbursement. And that is why companies often address this through a gross up. And there's 2 examples that I'll be providing today. A simple mathematical formula that grosses up at a flat tax rate, and a second methodology that accounts for brackets, progressive tax rates, deductions and maximums, etc. So the first one is a simple gross up using a flat tax rate, and the algebraic formula is you look at your net income, your net after tax income, and you divide it by 1 minus the tax rate that you're trying to use. So in my example here, I have 20,000 of income that needs to be delivered net of tax. The company needs to gross it up, and we have a combined tax rate of 39%. That's a combination of several different types of taxes. So we take 20,000, 1 minus 0.39. We get the actual gross income from that. And then taking that gross income answer, subtracting the net income, gives us the gross up tax itself. So if we applied 39% to the 32,787, we get a tax of 12,787. That is the appropriate amount to cover the tax on the tax on the tax in that example. But you'll notice it's no longer 39% of the net income item.
it's actually 63.9% of the net income item. So this is one of the things that really gets folks confused. Why are the tax costs so much higher? And it's because these tax reimbursements do need to be grossed up. Moving on to the other type of example, using incremental gross up process. What's nice about this methodology is you're grossing up at the employee's incremental tax bracket. And so you are using the leveraging of the progressive tax rates, if there's any deductions that get phased out, various other things that are happening within the tax methodology itself. And you go through a sequence of calculations. In my example here, I have 100,000 of salary, and I'm going to calculate tax on that, both federal, state tax, I think I said California, didn't I? And Social Security. We then get a net income item, which is step 2. I take that net income and add the items I need to gross up, which is the 20,000. So I'm taking a gross up on 105,375, doing my gross up, and then looking at the differences in the tax answers there. The step 4 tax, 26,000, the step 1 tax, 14,000. So my gross up on the 20,000 of net income is the 11,764. And that is 58.8% of the net income item. But it is taking into consideration what that individual's tax brackets are at between 100 and 136,000. Okay, I think we're on to another polling question.
Okay, a third polling question. How do you determine a gross up tax rate? A, estimated marginal tax rate of employee. B, top marginal tax rate. C, statutory payroll withholding rate. D, detailed calculation based on employee circumstance. Or E, I don't know.
Just going to give it another second or two.
Okay.
Okay, so the results are actually pretty close between first and second. 40% said detailed calculation based on employee circumstance, while 33% said estimated marginal tax rate of employee, closely followed by 19% at statutory payroll withholding rate, followed by top marginal rate tax rate, and then 9% said they don't know.
Yeah, that makes sense to me. I think people would be reluctant to use the highest top marginal rates unless they know the individuals in the highest income ranges. So I would think that they'd be trying to pick a spot where the tax brackets are for that particular individual. That's great. Okay, Chris.
Excellent. Thank you very much, Pat. And I think just to add to your comment there at the end, I think we are seeing, we have certainly seen here in the US, we've certainly seen a lot more of a desire to use a lump sum approach, what with the changes in the tax laws that came into effect at the beginning of 2018 with taxable relocation items. And we are seeing that there is confusion is not the right word, or some need for clarification on what is best practice, I think, as to what rate to use for the gross up. Then there isn't a right or wrong answer to that, really. It's more around what can your process manage, and what is your position in terms of the responsibility of the company and the employee within that. And so there can be a lot of discussion of what approach you take, and then I think as part of all of that, there needs to be a level of communication that goes on to the individuals involved, so that they understand how that gross up is being managed by the particular organization. So thank you for that, Pat. And it leads me in to this final section on really, what are the basics of managing mobility tax costs? At the beginning, I spoke that, taxation can happen very quickly. You have to consider tax, social security, and your payroll requirements when you are looking at setting up an assignment. So what we've got here on this slide is a few things based on our experience of do's and don'ts of when you're trying to manage these costs. One of the first don'ts that I would put out there is not to allow the business unit to start and drive the process. So the business units, and by that you may call it your divisions, whatever you call it within your firm, but the business itself that's looking to move individuals are rarely going to have the expertise and the knowledge to drive that process. I've seen this a number of times where that process may be done by the business unit, and then it takes a lot of effort to wind that back. So, oh yeah, we're going to send individual X from here to Japan, and we've already promised him this, 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 and this. When we then identify, well, this, and this all attract tax costs, and it will actually cost you 4 times more than you initially thought. Are you still prepared to pay those costs and sign off on that assignment? And quite often the answer to that is no, and then you have a difficult period of winding back with the individual. As such, what we'd recommend is that you are starting that process early, but also communicating to the business unit that there are hidden costs that need to be appropriately managed. My preference, to be honest, is that the business unit and mobility or HR have already agreed on a package before it's presented to the individual. When you get into a situation of negotiation with the individual about what is and isn't available, it tends to become a very protracted and sometimes a difficult situation, and can lead to poor relationships, which is not the way that you want to start an assignment with an individual that you're asking to move. I think it's vital when you are responsible for managing relocation costs and mobility tax costs, it's vital to clarify your expenditure. And as part of that, again, one of the don'ts is do not make assumptions on other countries. A classic assumption that I see here in the US is that other foreign nationals coming to the US will believe they can sell their home here while they're here in the US and it not be subject to tax. In the US, if you qualify for the exemption on the sale of a principal residence, then the exemption is only $500,000. Now, we've had several clients over the years who have moved over from London and have owned their home since the 1980s. They're sitting on multi-million-dollar gains, or the equivalent of multi-million-dollar gains, and that cannot be protected. So again, if somebody from the organization has said, oh, don't worry, we'll take care of all your tax situations, you've suddenly put your organization on the hook for a massive tax bill, which again, then in turn would need to be grossed up. And as Pat very eloquently put, that could be 67%, 80% again of that initial outlay. And so making sure that you understand, okay, this is what we're offering, this is how much it's going to cost us in this circumstance. And again, I can't stress the difficulty of trying not to make assumptions. Oh, well, this worked last time, it'll work this time. That sadly, in mobility tax, the complications that we face do not always mean that that is the case. So identifying that expenditure and then making sure that that expenditure is communicated. Making sure that the business unit who is requesting this move or needs this move is aware of what they are committing to. And that is very, very important when you are seen as being responsible for managing these costs. If you don't get that sign off, the danger is that when those costs start to grow, as they often will in an international assignment, that there is then pushback from the business unit, but you've already got the individual on the ground, and then it's very, very difficult. And again, it leads to poor relationships both with the employee, with the business unit, and a lack of trust there. We would recommend certainly.
The other thing I was thinking about in terms of the business units is they're the ones that often don't believe that the forecasted tax costs are right. They're the ones that don't believe that the gross up, after the gross up is done, they just don't believe that the tax costs are right. So getting that done ahead of time is very important.
Absolutely, absolutely. And we would recommend, the business unit first sign off on that budget. And then as a best practice, and I have to say over my career, I've seen this not happening at a lot of what you would assume to be very sophisticated organizations. But we would also recommend taking the extra step of working with finance to establish an accrual of those costs that then you work with your teams, your vendors, to help manage that accrual as you go through the process or the life cycle of an assignment. That is particularly important where you have things, and we'll cover some of this later in the series, but when you have things like trailing liabilities, when you have countries that may tax on a different timetable. So many countries around the world may employ a kind of post-tax year payment or true-up. And so payments, particularly Belgium is probably the most famous example of that, where you could have a tax payment due in Belgium several months, even up to over a year after an individual has left Belgium. If that accrual has been closed or no one is aware that there is another, whatever the number, $150,000 tax bill coming, and you suddenly, no one wants to take that cost, it becomes a very difficult issue. So again, we would see that really as being a best practice to helping your organization manage your mobility tax costs. And I know Air Inc. in particular have done a very, very good job of pulling a cost projection tool together, which helps with that first stage of that. And then you can take those numbers, sign off with the business unit, and then work with your finance team to manage that accrual through the process. And again, you would be looking to your vendors, your relocation managers, your tax vendors, to be feeding those numbers in and helping you and finance really analyze and identify those numbers to see whether you are still within that budgeted accrual. One of the things I would recommend that people don't do these days, because I see it so much, is assume that local to local is going to be the cheapest option. That seems to be a very popular approach now, but there are a number of occasions where just cutting somebody off and putting them on the other country's employment, that may be very simple from an execution perspective, but again, it may not be the right answer for the organization or the individual. Just an example of that, one I was working on the other day, US to the UK, sending somebody on local terms. In the UK, they have a 13.8% uncapped social security contribution for the employer. So the tax costs or the additional employer costs for this particularly high earning individual are significant. And therefore, just be careful when saying, oh, this is what we're going to do because it's the cheapest. It may not always be. Again, as I said, don't forget Social Security. And finally, the final thing I would always recommend when you're looking and managing these tax costs and these tax approaches is don't forget the human aspect. Yes, there is tax cost, there's complications, but at the end of the day, the organization needs to get done what the organization needs to get done. And so if you need somebody to be in that particular country for a certain amount of time, and they need benefits to be able to make them there and make them whole, or even to get them to agree, sometimes you have to do that and realize that, yeah, we have a duty to our employee, we have a duty to the corporate entity to get this done. So you just want to make sure that you're not ignoring that, and you don't get so focused on the tax side that you're ignoring the business needs. But again, when that is the case, or when you are considering those business needs, information and proper planning in advance is absolutely crucial. And I think with that, we'll move on to our last polling question, and we'll open the floor for any questions.
Okay, thanks, Chris. If you would like to receive a certificate for your continuing professional education credit, if you can all please answer this poll that I am about to launch. There we go. So if you can all take a moment to answer that, because that's very important if you do want to receive the certificate. And then with regard to your CRP credit, there are 2 slides included here with information on those credits. For those of you that actually attended today, your ID will be 15789. Again, that's 15789. And for those that that will be listening to this recording after and have not attended today, your seminar ID will be 15790. 15790. Again, there are 2 detailed slides in this presentation that have all the information with regard to the CRP credit. So I'm just going to give another moment for everybody to complete this polling question. And for those of you that have already completed it, if you have any other questions for Pat and Chris, if you could please post them to the question panel and we'll get to them in just a moment. Okay. So as I mentioned, there's some additional detail on the credits in these 2 slides. And then I have one final polling question that I'm going to share with you now before we get to the questions. So if you would like a representative from GTN or AIRINC to follow up with you or to learn more about our tax or other services, if you could please complete this poll. And while you're completing that poll, I am going to start the questions. So let's see. This first question is from David, and I believe this one is for you, Chris, as it's regarding the start of the presentation. On the initial scenario of the $20,000 for Canada, this only assumes when you exceed 183 days in Canada. Is this correct?
No, that is not correct. And that is a classic example of the myth that has been created around tax treaties and how they operate. So obviously, we have, we used to have a very good relationship with Canada from a trade perspective. So we do have a tax treaty in place with Canada. We have a social security agreement in Canada. Now, the tax treaty actually says that, yes, if you're in Canada for less than 183 days, you're not taxable on your employment income that you've made in that period. And so that would seem to be the case. However, and this is true of just about all tax treaties, there are other caveats that are associated to that. So there has to be a lack of a recharge to the corporate entity that is hosting the individual, and it has to be that the sending organization has not created what's known as a permanent establishment, and that's a very complex issue I won't get too into now. But basically what that is saying is that if you're recharging the costs of that 20,000 to the Canadian organization, the treaty will not actually apply, because the Canadian organization is typically going to be taking a corporate tax deduction for that 20,000, and therefore they'll typically look to match up the income tax on the same piece of income, and therefore in that circumstance Canada would actually have the right to tax that 20,000 even though there's a tax treaty in place. Great question, but it is a bit of a myth. Thank you for that.
The 183 day is definitely a myth.
Thank you, Chris. Thanks, Pat. So another question from Catherine. Is there a detailed chart for non-taxable or taxable reimbursement for visa/green card application cost, like an accountable plan?
Again, this will vary by jurisdiction. You would be looking for any sort of expenditure that would be classified as a true business expense that could be excludable. But I go with the general rule. I'm going to assume it's taxable unless I can find any provision that says that I don't have to include it. So for the most part, there's no any simple listing that shows which types of items would be non-taxable.
Great, thanks, Pat. And another question from Jennifer. Is it mandatory to use a gross up?
No, you don't have to, but that means that in my example, the 20,000 item that's being delivered, they're not going to actually receive 20,000. They'll probably end up with what, 12 or 13,000 after tax. So that's the reason why you wouldn't have most companies not delivering certain items as being subject to gross up. Then it's just a question of, are you looking at this person to be completely kept whole, a full gross up, or do you want them to participate in sharing the tax costs associated with that particular item? So not mandatory, but I think it is common practice to do net items being delivered after the gross up.
Great, thanks, Pat. And from Stephanie, if the per diem is under the daily threshold and considered non-taxable, is the employee required to submit an expense report?
Again, that probably varies by jurisdiction. Certainly outbound from the United States, you've got, I think somebody mentioned accountable plans. So that would be where you're actually accounting for the expenditure. There are some relaxed conditions that still allow you to meet the accountable plan rules, but yes, you can expect that you would need to demonstrate that they were at the post for that particular day, they were working for you, that type of thing. So there would be some accounting that would be necessary.
Great. And Catherine also would like to know how a relocation company can calculate the accurate gross up amount, because it looks like their provider is always under calculating it.
Well, that's a very challenging question, and it's one that I know Pat and I talk with our clients a lot about, of how and when and how do you set that limit. So for example, if you pay something to somebody at the beginning of the year in the US, are you going to gross them up for Social Security that may not have already hit the cap, or are you going to look into where they're or will they hit it during the year? Maybe then you're running the risk that they leave the organization. In certain countries, obviously the US being one of them, but in a lot of others, you don't really know what their effective rate would be because their spouse may work. They may take deductions on their tax return that you're not aware of. So there are a number of different approaches as to how best to prepare an accurate gross up. I think, Pat, I don't know what you're seeing, but I'm certainly seeing that the gross up at the 22%, which is the US statutory rate for withholding. I'm seeing that causing a few issues, certainly at this last year end, that that wasn't a substantial enough gross up, and therefore we are discussing different strategies with our clients.
Right. So if you have that type of situation, oftentimes you'll have them coming back to you after they filed their tax returns looking for more money. They didn't get enough of a gross up. So you could anticipate having to reimburse some extra after the year is over. When I described that second methodology of doing a sequence of calculations, that last sequence where we're actually doing the gross up, it's an iterative process where we're starting with the net income, we're calculating the tax, we get an answer, We then add the answer to the net income again and keep doing iterations upon iterations until we finally get where the answer equals the input. And so that's the way that we do a gross up within our tools.
Great, thank you. There are a lot of questions, so we're only going to get to a couple of more. So before we continue, I just want to remind everyone that you will receive a copy of today's recording and the deck. You'll receive that in an email within 24 hours of this session. And in addition, if you have not already registered for part 2 of this mobility tax series, we strongly recommend that you do, as the next session builds on this first one. And as you can see from the screen right now, the next session will focus on taxation of typical assignment types, an introduction to tax equalization and protection, taxation of short-term assignees and business travelers, and application of tax treaties. If you have not already signed up, you can do so from the AIR-Inc. website, and that's www.air-inc.com. So before we close, I'm just going to take 1 or 2 more questions. So Dusty would like to know if you can confirm if en route and repat airfare is still considered non-taxable for short-term assignments, or is it now considered taxable along with household goods post the 2018 tax law?
Okay, so we're talking about US tax law. I would say yes, because they're on an extended business trip. So those are business travelers. I wouldn't count family members. If they're bringing their family on an extended business travel, there's no business purpose to having the family accompany, so those would be taxable. Maybe that's confusing, but yes. Short term, yes, you can probably treat those as non-taxable. Anything to add there, Chris?
I think you'd want to take a look at household goods. Well, primary question of why you're allowing somebody on a short-term assignment to take household goods might be another question, but I'm not sure you'd be able to classify those as non-taxable. Depends what they are. That may even bring into the question the whole nature of whether it's a short-term assignment. I'd want more details on that, I think, but certainly the flights, I completely agree with you, Pat. Okay,
great. And as I mentioned, there are a lot of questions, so we will certainly follow up with everybody after the session to answer all the unanswered questions. And I would also like to ask that if you have a moment after the webinar, if you could take a short survey that you'll be presented with, as your feedback is very important to helping us improve our webinars going forward. So now we are out of time. So thank you, Pat, Chris, and Steve. And thank you, everyone, for taking the time to join us today. I hope everyone has a good rest of your day.